Hello, everybody. This is Chapter 5, Lecture number 1, and let's get started. We're going to be talking about something called the loanable funds market. So we've talked a little bit in Chapter 4 about some of the mechanics of interest rates. We talked a little bit about some of the source of risk, so say interest rate risk. We've talked about returns. We've talked about yields to maturity and measuring interest rates. What we want to turn our attention to in Chapter 5 is, well, how are interest rates determined? How do we figure out what that market interest rate is going to be? And so we're going to use a model known as the loanable funds market. And so you've seen this before. This looks like a standard supply and demand graph, except it's a little bit more complicated. Because what we have on this graph is demand for loanable funds, or demand and supply, or the market for loanable funds. So the first thing is, well, which one's demand, which one's supply? Well, the thing is, it depends on what we're talking about. Because, as you'll notice, the demand for bonds is upward sloping. Well, that's weird. Why is it that way? Well, because the demand for bonds is actually the supply of loanable funds. Because if I want to buy a bond, what does that mean? That means I want to loan you money. Right? I want to buy your bond with my money, and that's basically I want to give you a loan. So the demand for bonds is the supply of loanable funds. And the supply of bonds, all right, if I want to sell bonds, what does that mean? That means I want to borrow money. So the supply of bonds is the demand for loanable funds. So when we think about this, we could either think about it in terms of a bond market, in which case on the vertical axis we would put bond price, and everything would be flip-flopped. The demand for bonds would be downward sloping as a function of bond price, and supply of bonds would be upward sloping as a function of bond price. But remember, as bond price goes up, what happens to the interest rate? The interest rate goes down. So if I think about this in terms of supply and demand of loanable funds, where I put the interest rate, measured probably with something like yield to maturity, if we're talking about bonds, on the vertical axis, then they flip-flop. So the first thing we've got to realize about this is that it's a little more complicated than supply and demand from principles of microeconomics. But once we understand that, we can actually apply a lot of the same logic and principles that we learned in Principles of Micro. Namely, where's the equilibrium? Equilibrium is the intersection of the supply and demand for loanable funds. And what will happen to determine this supply, the equilibrium interest rate and equilibrium quantity of loanable funds in circulation, will be the interactions between supply and demand. So really what we need to do is figure out, well, what shifts demand for bonds or supply of loanable funds, and what shifts supply of bonds or the demand for loanable funds. All right? And I know that's weird because they're both. But you understand it's basically an identical way of looking at it. It's just we have to figure out, well, how we're measuring the vertical axis. Do we put the bond price on there, or do we put the interest rate on there? All right, so big yellow boxes that say what I just said. Probably I should have clicked through there. So let's talk about the determinants of bond demand. So within the loanable funds framework, we want to figure out, well, what are these determinants of the demand for bonds? So the number one, or the first of these determinants that we're going to talk about is wealth. And in general, as wealth increases, our demand for financial assets is going to increase. The more wealth we have, the more resources we have to manage, and the more need we have of things like bonds in order to manage that wealth. And so as wealth goes up, demand for bonds increases, shifting demand for bonds out to the right. 2, expected return. As expected return increases, then our demand for an asset also increases, everything else remaining constant. So, for example, there are 3 real ways that we can think about this expected return changing. Number 1, an interest rate decrease in the future. All right, if we expect some kind of interest rate decrease, well, what does that mean? That means the price of the bond will increase, which means, and not the current price, but the price in the future will increase, which means we're expecting a increase in capital gain, which would increase our expected return, which would shift our demand for the bonds out or increase our demand for bonds. 2, a decrease in expected inflation. If inflation goes down, then the real interest rate being returned by the bond, or the real return on the bond, will increase, right? Goes right back to the Fisher equation. Remember, real interest rate equals the nominal interest rate minus the expected inflation. If I subtract a smaller number, I end up with a bigger number in the end, right? Because if expected inflation goes down, I minus expected inflation goes up, assuming I stays the same. All right, if that goes up, then my expected return increases, which increases my demand for bonds. Finally, the expected return on other assets may decrease. Well, if the expected return on other assets decreases, then the relative return on bonds will increase. What does that mean? Well, let's just say you've got option A or B. A is something else that yields 10%. B is a bond that yields 5%. Okay, which do you want to do? Well, assuming everything is even, all other things equal, I want to do A because it returns more. Well, what happens if the return on A falls to 4%? Well, if all other things are equal besides the expected return, everything else is the same, I want to do bonds because, well, they yield more than A. Now, the relative return on bonds actually has increased. So the way an expected return or a relative return on an asset can increase in two different ways. Either the expected return on the asset goes up or the expected return on other assets goes down. Either way, I'm going to want more bonds, which means the demand for bonds increases, shifting the demand for bonds out to the right. And finally, I should just take a step back and do a brief reminder. What do I mean by expected return? Expected return is the weighted average of all possible returns where the weights on each outcome is equal to the probability of realizing that outcome. Okay, that's a mouthful. In other words, let's say I have a condition where one of two things can happen. For example, let's say I go to Las Vegas and on the street somebody offers this game, all right? And basically it's a coin flipping game. So you flip a coin, and if it comes up tails, you get paid $100. If it comes up heads, you get paid nothing. All right? So tails, you win $100. Heads, you win nothing. Okay, so what's the expected value of that game or that bet? Well, there's a 50% chance it will come up tails. So in that case, there's a 50% chance I win $100, or 0.5 times 100 gives me 50, plus there's a 50% chance I win nothing, or 0.5 times 0 equals, 0. I add those two together and I get $50. The expected value of that bet is $50. So if they come up to you and they say, okay, you want to do this and it'll cost you $45 to make the bet, yeah, go ahead and do it, but do it a lot of times and you'll come out ahead. You know, if you do it 10,000 times, you'll end up making on average about $5 every so many go-rounds. On the other hand, if they want $75, then obviously it's not a good bet, right? Because they want more than what the expected value of the asset is. So, you wouldn't want to do that. So the point is, expected return basically says let's take all the possible outcomes and let's weight them by the probability of that outcome. And that gives us what on average we would get if we were to rerun that particular trial, say, at 10,000 times. Okay, so let's turn to the loanable funds framework. Let's talk about factor number 3 of demand for bonds, and that's risk. So the riskier a bond is, the less I want of it. The less risky the bond is, the more I want of it. So if risk on a bond decreases, I want more of the bond, so bond will increase. But there's another thing that we can do about this, because it's also, we need to talk about relative risk. And the relative riskiness of an asset can change in one of two ways. Either the riskiness of the asset changes, or the riskiness of other assets change. So in this case, if the other assets become more risky, well, then it's, better to go with bonds. So let's we've got two different choices. We could go swimming with sharks or skydiving without a parachute. All right, now the skydiving without a parachute is a bad example, and I'll tell you why it's a bad example later when we talk more about risk, and you can come back and yell at me for using it here, but I'm going to use it now anyways. So skydiving without a parachute versus swimming with sharks. All right, that's basically two bad choices. But what if I say, okay, it's swimming with 10 sharks or jumping out of an airplane at 10,000 feet? Well, okay, they both actually sound like bad ideas. But what if I reduce it, to 5 sharks? Well, the jumping out of the airplane seems to be, relatively more risky now, because it seems relatively less risky to swim with 5 sharks than it is with 10 sharks. I don't know. This is just a bad example all the way around, because it just sounds really risky all the way around. But you get the idea. If it's not just about how risky a particular asset is, it's also about how risky the alternatives are. If all of your other alternatives are also really high risk, maybe this one is just the best choice out of other risky choices. So if the risk on other assets increases, well, demand for bonds will increase. So last time around, in a previous lecture, we talked about interest rate risk a bit. So that third one down here. But there really are what we call 3 sources of risk. In general, there's 3 sources of risk throughout all financial assets, and they can roughly be equated to this. These are specific to bonds, though there are analogies to other instruments. And the sources are, number 1, default risk. This is the risk that the borrower will not repay a loan, right? That they will default on the loan, and that's pretty self-explanatory. Then there's inflation rate risk. This is the risk that the real interest rate will be different from what is expected. Right? In other words, we think inflation will be such and such, but it turns out not to be. It turns out to be something different. All right? That's the risk that you're entailing when you talk about inflation rate risk. And finally, interest rate risk, which we've talked about, is really the risk that the bond price will change in a way other than what you expected it to be. That is, the nominal interest rate changes in a way other than what you expect. So those are really our 3 different sources of risk from a bond. Default risk, the fact that we just won't get paid back at all. Inflation rate risk, the fact that inflation will be different than what we expected. And interest rate risk, that's the risk that the price will be different from what we expect. Or the price of the bond will change in the future other than what we expect. Or the nominal interest rate, the yield to maturity, changes on us. Now, interest rate risk, of course, doesn't exist if we plan on holding the bond till maturity. All right, if we're going to hold it all the way to maturity, then the yield to maturity we calculate always stays the same. But if we plan to sell it before it matures, that's when this interest rate risk comes in. Now, what's important to note, we'll talk about some bonds being what we call risk-free. That's really shorthand. What we really mean is default risk-free. All bonds, even default risk-free bonds, are subject to the problems of inflation rate risk and interest rate risk. Inflation rate risk happens whether or not the issuer of the bond or the borrower complies with his agreement or not. Interest rate risk can happen regardless of what the actual borrower's behavior is, right? Because all the bond says to the borrower is you have to pay the coupon payment for this many periods and then the face value. Borrower can do that and not be in default, and yet we still have inflation rate risk and interest rate risk. So we will use this term risk-free bonds or risk-free rate. That refers to default risk-free. Another driver of demand for bonds is liquidity. So liquidity is, as we've talked about, the ability to change a financial asset into something else. Ultimately, it's how quickly and cheaply can we convert this financial asset into consumption. I mean, ultimately, that's what we're talking about when we talk about liquidity. But the more liquid a bond is, the more we want it. In general, we value liquidity because that gives us options. We can always change our mind, and that's valuable to us. So the more liquidity, as bond liquidity increases, our demand for the bond increases. Also, it's not necessarily about what happens to the bond. It's what happens to the bond relative to everything else. So really what we're thinking about is how liquid is this bond relative to other assets? And if the liquidity of other assets decreases, well, then that means that the demand for bonds will increase. we got this really screwy graph at the very beginning. Let me flash back real quick. All right, this screwy graph that was right here, right? Well, I flashed back to that, and we see that, well, demand for bonds is upward sloping. Now, I seem to remember, well, a little secret between you and me, I passed Principles of Microeconomics when I took it in undergrad, believe it or not. And I remember that demand is supposed to be downward sloping. Well, we talked about this a little bit already when we presented this graph to begin with, because the demand for bonds is the same thing as the supply of loanable funds. But let's dive into that just a little deeper to make sure we fully understand it. So, do bonds obey the law of demand? Answer is yes. Why? Because there's an inverse relationship between interest rates and the bond price. So the yield to maturity goes up as bond price goes down, and the bond price goes down as the yield to maturity goes up. To see that, it's really simple. Let's just write a simple little yield to maturity type equation where we have a one period thing where the future value minus the present value divided by the present value gives us the gross or the percentage change in value of, let's say, a one period asset. All right, so we're just doing one period. At the beginning of the period, I pay P, and at the end of the period, I get paid back F. And if I want to calculate the interest rate over that 1 year period, that equals, well, that formula there. And notice, if I solve that around, I end up with F over P minus 1. Now, that's just simple algebra splitting up that fraction. If that bothers you, send me a question, and I'll be happy to talk you through that. But notice, price is in the denominator. And if I look at the right-hand or left-hand side of the equation, interest rates are in the numerator. So as interest rate goes up or yield to maturity goes up, what's going to happen? P has to go down to maintain the equality. And as P goes up, what has to happen? Interest rate has to go down to maintain the equality. All right. Notice they have an inverse relationship with one another. This is a really kind of confusing thing. Note that expected return in this case is equal to I. So, demand for bonds is positively sloped related to interest rates and negatively sloped related to bond price. That's the gist of this slide. This result holds for the more general case of a coupon bond, and we're not going to do that because it's a good deal more complicated algebra, but basically we can show that in a very similar way. So, the next part of the loanable funds framework are the determinants of bond supply. And so we're going to look at roughly three different, at least on this side, three drivers of bond supply. And the first one is profitability of investment opportunities. So first of all, let's remember, what is bond supply? That's demand for loanable funds. What does that mean? When I sell a bond, what am I trying to do? I'm trying to borrow money. Well, when am I willing to borrow money? When I think I'm going to make money on this business venture that I'm wanting to borrow money to do, or when I think I'm going to lose money on it? Well, of course I'm not going to borrow money to do a business that I think I'm going to lose money on. I think I'm going to borrow money to do a business that I think I'm going to make money on. And so as whatever the investment opportunity, and notice I'm using the word investment here in the economic sense of the word, not in the finance or vernacular sense. Investment opportunity means buying stuff to make businesses. All right, so remember, I'm using the word investment in the economic sense here. So if the business opportunity that presents itself is better, well, then I'm going to be willing to supply more bonds. I want to borrow more. And so we can see this in things like, business cycle expansions or investment opportunities increase. Either of these kinds of things happen. That means the profitability or the expected profitability of investment opportunities increase. I want to borrow more. And so supply of bonds increases. Number two, expected inflation. Basically what's going on is when expected inflation goes up, then the cost of borrowing goes down. Why do I say that? Because if I expect inflation to be higher in the future, what does that mean? It means I expect prices to increase, which means the value of the dollar is going to be less. So my money is going to be worth less because we had higher prices, because I expect inflation. So what's going on with expected inflation? Well, when the expected inflation goes up, that means I expect the value of money, and I'm going to be a little US centric here and put US dollars, but fill in whatever currency you're talking about. I expect the value of that dollar to go down, and therefore cost of borrowing goes down. All right? So another way to see this is I'm borrowing expensive money. I'm asking you to give me high-priced money when in a lower price level area. So goods cost less, so money is more valuable. Wait a minute. Next period, goods are going to cost more, so the money is going to be less valuable. So I'm going to pay you back less valuable money. So inflation always helps the borrower and hurts the lender. So if you're a net borrower, inflation is good. If you're a net lender, inflation is bad. Why? Because the borrower borrows expensive money and pays back cheap money. So inflation is, expected inflation going up makes me want more bonds because it makes me want to sell more bonds because it reduces the cost of borrowing. And finally, we have government activities. So the government wants to spend a certain amount of money. Suppose it wants to spend more money than what it actually takes in. So if the government takes in revenue certain amount of money, but then wants to spend more than that revenue, the government has what's called a budget deficit, right? How do you pay for a budget deficit? Well, there's really three ways you can pay for deficit spending or a budget deficit. Number one, you can raise taxes so that revenue goes up so that you don't have a deficit. Number two, you could, actually there's four ways. You could print money. I could just print more money, increase the money supply, and then use that money to pay for that. But we've talked about that in previous chapters that, if I let the money supply grow too quickly, I end up with lots of inflation, and it's just a bad thing. So that's not necessarily a good idea. Increasing taxes may or may not be doable. A third alternative is I could steal it. And I know that sounds kind of flippant and maybe a little silly. But actually throughout most of human history, that was the preferred method of raising funds. You go to your neighbor, you take them over, and then you demand tribute. In the 20th and 21st century, we've kind of gotten away from wanting to do that, thinking that's a bad idea. But basically, that's more of a recent development. But I don't think we want to go stealing it, so the last option we have is to borrow it. Now, if we're going to borrow it, where are we going? We're going to issue bonds. So if I have increased deficit spending and I'm borrowing to do this as a government, I'm going to issue bonds that's going to increase the supply of bonds.